New data has emerged revealing that Jane Street added 20.6 million shares of SLV in the fourth quarter, making the firm the largest holder of the silver ETF, with a position valued at $1.3 billion. This development is occurring against a backdrop of significant price action in silver markets following Wednesday's trading halt, alongside new data on lease rates, swap rates, and physical inventory levels that are drawing attention from market observers tracking the structure of both Eastern and Western precious metals markets. In terms of price action, silver dropped to $87 following Wednesday's halt, with the zone between $87.20 and $89, previously identified as a resistance level, acting as new support. Price bounced back to $90 before declining sharply to $85, where the 150 exponential moving average has served as a confluence support level. Silver is currently trading at $86. That 150 exponential moving average at $85 is identified as a key technical level to monitor in the current environment. The Jane Street position is being examined in the context of the firm's documented history across other markets. The Securities and Exchange Board of India accused Jane Street of generating unlawful gains of approximately $550 to $567 million, tied to alleged manipulation across specific expiry days in Indian securities markets. The board temporarily barred the firm from Indian securities markets in July 2025. That ban was later conditionally lifted following compliance measures, with the full alleged unlawful amount deposited into an escrow account. The manipulation case remains ongoing with appeals pending. The firm is also reported to be under regulatory scrutiny in China, following the India probe. Alongside the Jane Street disclosure, structural data across silver markets is presenting a series of developments that connect physical lending markets, futures open interest, vault inventory levels, Eastern premiums, and regulatory changes in India. Each of these data points will be examined in full detail in the sections that follow. Turning to the mechanics of institutional trading behavior as described in the source material, the documented playbook attributed to institutional quantitative firms involves several sequential steps. First, sufficient shares are accumulated to influence market price action when required. When the majority of traders turn bullish, put options become inexpensive. Those put options are then purchased in large quantities. At the appropriate moment, the entire accumulated share position is sold simultaneously, creating sudden heavy selling and a sharp price decline. Retail participants react by triggering stop-loss orders at scale. The put options gain significantly in value over a short period. Spot positions are then repurchased at lower prices, short positions are squeezed, and upward price momentum is created through FOMO-driven buying before the cycle repeats. Jane Street is reported to have run similar strategies in Indian markets, with the Securities and Exchange Board of India accusing the firm of using coordinated morning purchases to influence index levels before profiting on options positions. The regulatory findings cited unlawful gains of approximately $550 to $567 million, tied to alleged manipulation across specific expiry days. The temporary bar from Indian securities markets was issued in July 2025 and was later conditionally lifted after compliance measures were taken, with the full alleged unlawful amount placed into an escrow account. Appeals remain ongoing, and the case has not been fully resolved. The firm is additionally reported to be under regulatory scrutiny in China following the India proceedings. The same structural sequence is described in the source material as being applied in Bitcoin markets, where the approach involves holding substantial investor capital, purchasing spot Bitcoin, opening large short positions via options or derivatives, and then executing large volume selling through algorithmic trading, combined with low liquidity conditions or negative news, to trigger panic selling. Following the resulting price decline, short positions are closed for profit, while spot losses represent only a fraction of the gains. Spot is then repurchased at the lower level, shorts are squeezed, upward momentum is created, and the cycle begins again. The source material notes that with Jane Street now holding $1.3 billion in SLV as the largest holder, the same dynamic is structurally present in silver markets. The source material also notes that the Securities and Exchange Commission and the Commodity Futures Trading Commission relaxed ETF rules around 2020, including modifications to derivatives use requirements and transparency standards. Jane Street's profits are reported to have surged from 2020 onward, reaching record levels exceeding $20 billion. Enforcement actions from regulators in other countries followed in subsequent years. Turning to the broader structural signals visible across silver markets, the data from lending and swap markets is presenting notable readings. Under normal market conditions, 1-month silver lease rates trade around 0%. sometimes slightly positive when lenders seek returns, and sometimes slightly negative when excess inventory exists in the market. The average lease rate was positive 0.04% in 2023 and negative 0.18% in 2024. The current lease rate stands at positive 1.6%. The source material identifies anything above 0.5% as a signal of stress in physical lending markets. At the current level, market participants are paying significantly more than normal to borrow physical silver, not for speculative purposes, but to meet delivery obligations that cannot be fulfilled through other means. Silver swap rates are currently at negative 2.8%. Under normal conditions, swaps, which involve temporarily exchanging silver for cash, with cash, earning interest while avoiding storage and insurance costs, trade slightly above cash rates. The fact that swap rates are deeply negative means market participants are paying to secure physical silver today while committing to return it 1 year from now. The source material notes that this situation represents what would appear on paper to be a free arbitrage opportunity, yet no participants are taking that trade at scale. The explanation offered is that the market does not trust that physical silver will be easy to source 1 year from now. The source material characterizes the problem not as one of capital availability, but as one of certainty of delivery. Connecting these lending market signals to the Wednesday trading halt, volume data recorded 31,828 contracts changing hands, while the metals market was halted, representing 159 million ounces of silver, potentially cash settled, during a period when retail traders had no market access. The source material identifies this as the second major halt in 3 months, with both halts occurring immediately before first notice day of the largest contract months. February gold contracts are reported as still showing 4,000 contracts open, representing 12 tons valued at $2 billion that have not settled despite being past their settlement date. The Shanghai Futures Exchange is also reported to have suspended 25 trading groups in February for position limit violations. On the Eastern market side, Shanghai spot silver is trading at $97, with Shanghai futures at $100, while Western spot sits at $86. That represents an $11 premium on physical silver in Eastern markets while Western paper markets consolidate. The source material states this premium has persisted through multiple failed breakouts and trading halts, characterizing it as structural separation rather than temporary arbitrage. Comex open interest is reported as being at its lowest level ever recorded. Registered silver on Comex now stands at 86.3 million ounces, continuing the declining trend noted in prior reporting periods. Regarding India, the Securities and Exchange Board of India has authorized $385 billion in actively managed equity funds to allocate up to 35% of holdings into silver and gold instruments, representing institutional capital receiving regulatory permission to rotate into hard assets at scale. Central banks are also described as continuing to accumulate physical gold at record pace. On the mining equities side, silver is reported as being approximately 27% off its highs at $120, while silver mining stocks are only approximately 6.5% off their highs during the same period. The source material identifies miners outperforming the underlying commodity during a correction as one of the most structurally significant signals observable in this context. Bringing together the full scope of developments covered in this report, the picture that emerges spans institutional positioning in silver ETFs, physical lending market stress signals, futures market structural data, Eastern premium persistence, regulatory developments in India, and mining equity behavior. Each of these data points drawn directly from verifiable on-record sources as presented in the original material. Jane Street added 20.6 million SLV shares in the fourth quarter, making the firm the largest holder of the silver ETF, with a position valued at $1.3 billion. This development is being examined alongside the firm's documented regulatory history, which includes accusations from the Securities and Exchange Board of India of generating unlawful gains of approximately $550 to $567 million tied to alleged manipulation across specific expiry days in Indian securities markets. The board temporarily barred the firm from Indian markets in July 2025, with the ban later conditionally lifted following compliance measures and the deposit of the full alleged unlawful amount into an escrow account. The case remains ongoing with appeals pending. The firm is also reported to be under regulatory scrutiny in China following the India probe. On the price action side, silver dropped to $87 following Wednesday's trading halt, with the zone between $87.20 and $89 holding as support before price bounced to $90, subsequently failed, dropped to $85, and is currently trading at $86. the 150 exponential moving average at $85 is identified as a key confluence support level. The March roll moved 71 million ounces forward, relieving immediate delivery pressure. The source material presents this as part of the delay case, that Comex can continue rolling contracts into May and July to defer delivery obligations further. On the physical lending market side, silver lease rates currently stand at positive 1.6% against averages of positive 0.04% in 2023 and negative 0.18% in 2024. Silver swap rates are at negative 2.8%, meaning market participants are paying to secure physical silver today while committing to return it 1 year from now. The source material identifies the absence of participants taking what would appear to be a free arbitrage opportunity at these swap rate levels as evidence that the market does not trust physical silver will be easily sourceable 1 year from now. The problem is characterized as one of certainty of delivery rather than capital availability. Volume data from Wednesday's halt recorded 31,828 contracts, representing 159 million ounces, changing hands while retail participants were locked out. This is identified as the second major halt in 3 months, both occurring before first notice day of the largest contract months. February gold contracts still show 4,000 open contracts representing 12 tons valued at $2 billion that remain unsettled. The Shanghai Futures Exchange suspended 25 trading groups in February for position limit violations. Comex open interest is at its lowest level ever recorded. Registered silver on Comex stands at 86.3 million ounces. In Eastern markets, Shanghai spot silver is at $97, with futures at $100, against Western spot at $86, an $11 premium that has persisted through multiple failed breakouts and trading halts. In India, $385 billion in actively managed equity fund capital has received regulatory authorization for up to 35% allocation into silver and gold instruments. Central banks continue accumulating physical gold at record pace. Silver mining stocks are approximately 6.5% off their highs, while silver itself is approximately 27% off its highs, a divergence the source material identifies as a structurally significant signal. The source material presents the following as factors that could delay further price development. Jane Street's SLV position giving the firm capacity to influence short-term price action. The Shanghai premium potentially narrowing if Chinese industrial demand softens seasonally, and Comex continuing to roll contracts forward to defer delivery pressure. Against these delay factors, the source material presents lease rates at 1.6%, swap rates at negative 2.8%, volume printing during a trading halt, open interest at all-time lows, and miners outperforming the commodity during corrections as data points that cannot be attributed to paper market activity alone. All figures, regulatory actions, volume data, lease rate readings, swap rate levels, vault inventory figures, and Eastern premium data referenced throughout this report are drawn directly from the source material and are recommended for independent verification through primary sources including Comex registered reports, lease rate data, and documentation of the Jane Street regulatory proceedings. That concludes this broadcast report on current developments across silver markets, institutional positioning, physical lending market stress indicators, and related regulatory and structural activity.